Hi, this is Roger Conrad. I'm editor of Utility Forecaster. What I want to talk about today is whipsawing and how this has become a major danger to investors across the board. In fact, I would call it the biggest danger right now, bigger than inflation, bigger than economic weakness, and bigger than the government, which has certainly set a lot of people on edge recently. What is whipsawing? Well, it's basically when you get taken out of a stock for no good reason. And right now, one reason that people are getting taken out of some very good securities is that they're setting their stops too close to the prices of the securities they own. Now, why are people setting stops? Mainly because they're worried, and I can't blame you if you are concerned about some of the major challenges facing the economy, facing the markets today. We may well see another correction. We may be in the beginning of one right now. But setting stops too close to current prices of securities you own almost guarantees you're going to be taken out at a bad price. It guarantees tax hassles because particularly if you've held anything over the past year, your chances are you've got a fairly nice gain in it. And it takes you out of the most important part of income investing, which is garnering those yields and watching the prices of good securities go up as they increase those yields. Now, certainly there's the possibility of a downturn. Certainly there's the possibility that we'll see some red ink in some of the positions that we hold. But what's really the downside? What are we really talking about here? Let's go back to late 2008. Certainly a horrible year for the stock market, a horrible year even for very, very strong income investments. Everything took a bath. But those very strong income investments came back. Let's take the example of Enterprise Products Partners, for example, which got down into the high teens at one point. Absolute bloodbath, and maybe a lot of people got out at that point. But if they did, I imagine they're pretty sorry because Enterprise has now been hitting new highs. In fact, highs above where it was even at the peak before this correction began. So what did those gain by putting in stop losses or bailing out at that point? Well, they basically were taken out of a very good security that could have generated them a lot of income as well as a lot of capital gain. That's exactly the position you're putting yourself in if you set these stops close to these income investments. These things have proven themselves. They made it through the 2008 downturn. They made it through what's been called the worst credit collapse in 80 years, one of the most severe recessions certainly in decades, and have gotten through with flying colors. No dividend cuts. In fact, increasing dividends across the board if you look at the Utility Forecaster portfolios. Again, this is a list of very high-quality companies. They've been chosen because of their ability to weather various markets. They may take a hit here and there because of what happens in the market, and now that a lot of these things have come up fairly substantially over the past year, they may take a hit when they issue equity or when a brokerage decides that maybe it's outrun its gains. But the only way that hurts you is if you set a stop loss too close to the current price. Because when stop losses are executed, they're executed across the board. You don't get out at that price. You basically get sold when that price is breached. So that's why if you take a look at some of the graphs of some of these stocks and these tremendous moves that we see in one day, you can just see the people who've gotten taken out at those bad prices. And, certainly people came right in and bid the things right back up the next day. So avoid this strategy. It makes people feel safer to say, well, I've got trailing stops in. Well, I've got stops in here. But for income stocks, it really doesn't make a whole lot of sense. What you really have to just steel yourself to is here. You're buying a business. You're buying a business that's growing, that's building wealth, that's increasing its dividend, that's very, very strong in the face of recessions and has proven itself in the worst possible conditions. And this is a pretty good vehicle to keep riding. Now, if you get out, if you decide, well, I just can't handle the volatility in the market, you can help yourself to the 0.5% money market yields that are available out there, or some of the passbook savings rates out there. But this is really a strategy that's going to doom you in the long run. Stick with these positions and don't put these stops in. That's all I have to say today. Thanks for tuning in. I'll look forward to chatting with you next time.